Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Here we have another video about the truth. The truth about what? About so many people who are in debt. So let's see what she has to say.
Friendly reminder that if you're jealous of others for how they spend their money and wonder how they're affording all these things and doing all these cool things, they're in debt. They're in a lot of debt. People are in a lot of debt and we don't talk about it. So if you have minimal debt, congrats.
That's it. 15 seconds. But you know what? I think for someone her age, and I know I felt this shock at her age, there are a lot of people who play charades. I feel like the biggest shock that I experienced as a young adult was just that there's so few people who keep it real and just can't say, "Hey, I'm learning," or "Hey, let's learn about this thing called life together." They want to fake it till you make it, and the reason why they can do that is because we have this monetary system that allows you just to go into debt to portray an image of something that you're really not, right? And so what we're going to do today is the same thing that we do every day, Pinky. We're going to try to take over the world. No, we're going to try to pay off debt using something called velocity banking. And we just do this pretty much every single day, right? Every single day. So, how do we do velocity banking? How do we pay off debt? It's easy. Number one, step one, you create a budget, right? Income, expenses, leftover checking and savings. And we have how many credit cards? We got six credit cards, not a loan, a mortgage, and then our personal expenses. So, here we actually make a really good income. Really good income. Like 75 what $6,000 a month is about $100,000 a year. I don't know if you knew that or not, but $6,000 a month is about $100,000 a year. And so if we make 7,500, I would say maybe like after tax probably 120 30ish, right? 120 30ish. And so that's what we're going to do. So why create a budget? Because our budget is our debt attack plan. And remember, when you do an expense breakdown, you have to list every single debt as its own line item, right? So we have eight debts here. And then here we have our general expenses, things that are not debt. So if you're renting, the rent would be included in this column. But because we have a mortgage, the mortgage is a debt, right? And so let's go ahead and do the velocity banking side. So what we do is we assume we have the same income and the same expenses, and we have zero in our checking and savings. Absolutely nothing in our checking and savings. And then what we're going to do is we're going to focus on this cash flow number. So, what is velocity banking? If you're going to deconstruct it, right? Like, what is it? I'm so confused. That's what I hear a lot of people say. And really, what it is you're just putting all of your money into debt. So, you're not saving it and you're using something called the line of credit to help manage your cash flow while you put all of your money into debt. That's all it is, right? So it's just a fancy way of saying don't save money, but you make it really, really easy to not save money, right? So a lot of people, the reason why they cannot pay off debt is because they have the urge to save money. I don't know if you knew that or not. They have the urge to save money. And that's what we're going to do today, which is pay off our debt. And we're going to assume we have access to a line of credit. So it's a line of credit. It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. So there's business lines of credit, personal lines of credit, home equity lines of credit. A credit card is technically a line of credit, although it's not as flexible because with the other lines of credit, you just go to a bank's website, click a button, and then you just pull money out, right? And so now what we're going to do is we're just going to assume we have a line of credit, right? And if we only have $127 left over, and this is the pop quiz about banking I always have to ask, are you going to, or is the bank going to give you a free and clear line of credit? Is the brain, at this stage of your life, with $127 left over and you have eight debts, is the bank going to give you, let's say, a new credit card or a new loan? The answer to that is no, because banks don't lend money to people who need it. The bank is kind of like a vampire. When a vampire sees a person with no blood, the vampire doesn't want anything to do with you. Same thing with the bank. You see, people who need money are like people without blood to a vampire. So what the vampire wants is someone with lots of blood, and someone with lots of blood is someone who makes good money and doesn't have a lot of debt. And then you'll notice as the more debt that you obtain, okay, the more debt that you obtain, you will not be able to get more credit because you've run out of blood, essentially to the bank. Okay, so banks don't lend money to people who need it. But if you did have a free and clear line of credit, oh man, that'd be so easy. But we do have. Okay, let me just mention this before I go on to the next section. We do have a 99-cent membership where I went through a realistic case scenario, a real life case scenario of someone who had 22 debts and $5 left over and was making 5,500 a month. So if you want to see something really realistic, go ahead and join the YouTube channel 99 cents. You have access to that live stream. All right, so this is what we're going to do. Okay, so we have these credit cards and we have the auto loan and the mortgage. And so what we're going to do with all of these debts is we're going to use a formula called the cash flow index, right? So basically you take the debt amount, you divide it by the payment, okay? Debt amount divided by the payment, you're going to get this arbitrary number, and then you think of this number as a ranking system, right? So what does this cash flow index mean? Basically, the lower the number, the more bang you get for your buck in terms of cash flow. So why do we pay off the mortgage last? It's a very high number because I literally have to give someone $330,000 in order to get $2,000 of my cash flow back. Whereas if I pay this $30,000 credit card, just only $30,000 and possibly this 27,000, I almost get the same amount of cash flow for paying this debt off. So it doesn't make sense to pay off the mortgage first. It makes sense to pay off the mortgage last because I got to give a ton of money to get a little bit of cash flow, right? A lot of people are tempted to pay off the mortgage first because it's tied to their home. Okay. All right. So now what we're going to do is take these low cash flow index numbers and let's see how much credit card debt we have. 5, 8, 15, 27, 37, and then we're going to sum up our credit card debt. So that's $92,000, okay? 92,000. So think of this as like a credit card balance transfer. We're just transferring the debt. We're not making more money, right? We're not doing that yet. All we're doing is transferring the debt, right? You see how the income is the same? So what happens when we transfer the debt? Oh my goodness, right? Oh, this credit card goes to zero, and now somehow this $127 turns to $3,182.42. So you see how that works? Like, oh my goodness, $127 of checking and savings somehow turned into $3,182.42 of cash flow. And then now the final step is we're going to dump our entire paycheck into that line of credit, take our expenses out, and then rinse and repeat over and over again. And after every single month, the balance of the line of credit should go down about $3,000 plus some interest, right? So what we're going to do is we're going to, let me do this. Calculate the next month's balance, which is based on the previous month's balance, previous month's interest minus our cash flow, so 3182.42. And then what we're going to do is we're going to take the average daily balance, right? Because that's how they calculate the interest in line of credit or a credit card, multiply by the interest rate, and then you divide by 12. So interest rate is 8%, you divide by 12, and then you'll see that the interest for the month is about $600. So I'm going to go ahead and copy and paste that, and then you'll see that in about how long? Mm, ah, Let me copy and paste. In about 33 months, right? 33 months, it's pretty much just been paid off. So less than 3 years. So remember, we were on the struggle bus in with $127 left over. In less than 3 years, we've pretty much gotten rid of all of our credit card debt. So 33 months in about 92K, right? 92K. And let me go ahead and copy and paste. And then now we have two more loans, the auto loan and the mortgage. So we got this loan calculator right here. So what we got to do is just put the current month and it's going to tell us the current balance, right? So we just put in the original factors of the loan, which is the original balance, interest rate, and term. We could spit out a payment, and then if we put in the month, it could tell us the latest balance or the current balance of these loans. And then you'll see right here that we have the cash flow index. So it make the cash flow index saying go pay this one off first. So let's go ahead and pay off 14,000 of the car loan left. Okay, so we're going to go ahead and do that. So that one's going to be plus 14057.31. And then what happens there? Well, let's go back to the auto loan. So the auto loan is right here. So it's $539. And then now this becomes a zero because we just transferred the debt. And so now what's our cash flow? It's $3,721.48. So what we're going to do is I'm just going to go here and then I'm going to go ahead and copy. Was this where I go? Yeah, copy and paste. And then this is going to be 3721.48. 3721.48. And then I'm going to copy and paste. And then we see that in 37 months, right, just 4 more months, our auto loan is paid off. Woohoo. Okay. So now it's 37 months. And then that's going to be 92 plus 30. So that's going to be 122K. And then now all we have is the 30-year mortgage, right? So let's see what the current balance is at 37 months. Whoopsie, 37 months. So we have two options here with this $316,000 balance, right? The most important thing when it comes to 30-year mortgage is you just pay it off last. So you have two options. One, you could just put all of your, make the monthly payment, and then put the cash flow as an extra payment, right? Number two is if you have a very hard time, like most people, overpaying a mortgage, just move it into a line of credit and then dump all of your money into a line of credit, right? And so what this is called chunking. So you just move a piece of the loan into the line of credit and pay it over and over again. So let's say in this instance, right, we just take a small number like $8,000. So I'm just going to move $8,000 here from the mortgage into the line of credit and then pay it off in our cash flow. And then you see that in that $8,000 gets paid off in 2 months, right? So that's just what all this is. And I have this fancy calculator that demonstrates what the payoff would be. Hold on 1 second. Let me go ahead and log in to my account. Okay, there we go. So all I got to do is just put in the numbers here, right? And then so whether you're using 8%, 15%, we could just do all these experiments. And one of the things that people are really afraid about are like high interest rates. But if you know how to structure the debt correctly, you don't necessarily have to be afraid of high interest rates. What you got to be afraid of is unproductive debt, right? So let me go ahead and just put this in right here. And what is the current balance? The current balance is 316,684.3, 316,684.3. And then I'm going to just show you a few things, but let's start with 8%. And the balance, or I'm sorry, income is 7,500. The living expenses is everything except for the loan we're trying to pay off, so 1,800 right here. Okay, and we'll just do an $8,000 chunk. Okay, so this gets paid off in about 5.5 years. Now, let's say we somehow double the interest rate, right? 15%, still 5.5 years, but the amount of interest that gets paid is about $2,000 more, even though we literally went from 8 to 15. And then if we do 8 to 30, right? That's about, it's a little bit more, 5.6 years instead of 5.5. And then this is 61 to 55, so that's like 6 grand more. Okay, 6 grand more. So, yeah. Anyways, all right, so now that was pretty easy. So 0 and then 37 divided by 12 plus 5.5. 5.5, so that's about 8.58 years, and then we are debt free. All right, so that's pretty much the truth about debt. A lot of people are in it, and people don't know how to get out of it. And so let's just kind of watch one more time about how everywhere you look, there's debt everywhere, right?
Friendly reminder that if you're jealous of others for how they spend their money and wonder how they're affording all these things and doing all these cool things, they're in debt. They're in a lot of debt. People are in a lot of debt and we don't talk about it. So if you have minimal debt, congrats.
Okay. Well, it's not even minimal debt, it's zero debt, right? After 8.58 years. All right, well, that's it for today, folks. If you made it to the end of this video, type in the comment section below, this is the best cult ever, and then I'll give you a heart on the comment, right? Just type in best cult ever, okay? All right, well, that's it for today. Have a great day, and I'll see you on the next video.